Glad to have you on the show today. This is the Retirement Education Hour. I'm Megan Mozak, and I'm joined by financial instructors Kirk Cassidy and Dr. Paul Mettler. They're with the Retirement Education Foundation. And throughout the show, we'll be sharing with you about the Foundation's courses, retirement courses that are taught throughout the year. And these are taught at local universities throughout our community, including the University of Michigan, Eastern Michigan University, Michigan State University Novi Campus, and Oakland University. We'll tell you how to register, what will be discussed, what you'll walk away with, and much, much more here on the program today. You can find out more information at the website. Go to retirementplanningedu.org. That's retirementplanningedu.org. We have a big show today. We're going to talk about some of the growing risk of market expectations. And Kirk and Paul, I'm interested to get your take on this because, you know, the market right now, people are wondering what's next, what's in the future for the market. How do we set our expectations when it comes to the market?
Well, I think we're going to talk about today how to set our expectations for performance, but I think we'd be dismissed to ignore what the general retail investor believes is a reasonable expectation for returns because it's never been as high as it has been, and I think a lot of people are going to be disappointed.
Yeah, no, I agree. And I think as we're going to talk about the risk of this growing expectation is going to have a huge impact on people who are thinking about retiring soon, because if you go into retirement thinking what the average retail investor's thinking, you have the potential of really getting hurt by this.
It's funny, Paul. I just, again, invited onto a local TV show, morning show, this coming within the next week or so, to discuss the impact of the market and retirement, COVID, inflation, and all those things. And I think one of the mistakes that a lot of people preparing for retirement are making right now is this expectation of these returns similar to what we've had over the last 5 to 10 years. And it's unrealistic, and as a result, that people are taking on greater risks than they need to and can afford to.
Yeah. You know, the one thing I continue to be amazed by, Kirk, is that
they put me on TV?
No, although sometimes I'm amazed by that. No, you know, over the course of how many years, many, many years, we've had this conversation where Americans' memory is just so short. And it wasn't that long ago that we were sitting down and talking to people, and they were panicked. And they were like, I want to be in cash, and I want to be conservative. Oh, my God, the world's ending. And how many months later, now all of a sudden people like the world, you know, I want to invest everything in all equities and you know, it's like, did you just forget what it felt like?
Yeah, it's sort of remarkable because the economy was shut down. The market started to boom, right? I mean, really, the market started to fly. We're up. It's incredible since March bottoms.
Right.
And it's never seen before. And so as a result, Paul, here's the number. I mean, I hope everyone's sitting down because recent surveys show that the retail investor has an expected future return of 17.3%. Now,
so one more time.
Yep.
One more time.
So the expected future returns, this is what retail investors believe the return they should get, they're going to get, is 17.3% per year, Paul. Now, be fair, they're polling people with investable assets of over $100,000. Mm-hmm. And, you know, I was blown away by that number because that isn't anywhere close to historical performance of the markets. And quite frankly, it's the widest gap between institutional people who like manage money and what retail investors' expectations are. Because us institutional managers, I mean, you can look at JP Morgan, Morgan Stanley, Barclays, Goldman Sachs. Their forward projections over the next 10 years is like 13% less, right? I mean, they're at
3 or 4%.
They're at 3 to 4% expected returns over the next 10 years, where the retail investors expecting over 17%. So this is a problem in understanding the importance of returns versus income planning is something that also needs to be acknowledged. And these are all the things we're talking about in our 7-hour courses that are taught at all the major universities. If you'd like to register for one of these classes, all you have to do is make a $29 donation, and you can attend and register at retirementplanningedu.org. That's retirementplanningedu.org.
Kirk, if I could just add 1 point to that number, you said 17.8, that is above inflation, right? That's above inflation. So really, if you assume inflation is 2%, people really are expecting over 19%. I mean, that's just outrageous.
Well, yeah. In fact, I think the projections they're using in that survey was an inflation of closer to 3%.
3%. Oh my.
So they're really expected returns of 20%.
20%. Right. And that study talks about why, and they talk about the whole concept of recency bias, right? Which we all struggle with, right? This idea that, okay, just because the market's been doing great lately means we assume it's going to continue. And we have recency bias in a lot of things in our lives, but this is not one place that we want to have recency bias.
No. So, Paul, I think today, I totally agree. And I think today, as we go through these different segments, I hope everyone sticks around because we're going to talk about why your expected returns and you should manage some of these expectations so you don't set yourself up for failure, and how dangerous this can be, particularly as we get closer to retirement, within 10 years of retirement. Our goal is to teach you, and that's always the goal in this class. Listen, it's a reflex in this show. It's to share with you the things that you really should be focused on to drive performance in retirement, not just rates of return. So I know conventional wisdom is as we get closer to retirement, we reduce our risk. It's not that simple. Your risk should be driven by what you need to give you what you want in retirement. And that's what we're going to teach you, how to adjust your relationship with money so that it's better suited and closer to what you'll experience during your retirement years. So, as we always say at the end of every segment, we're hoping that through these radio shows, these different segments, that we are going to encourage you guys and share with you the information to make you want to attend one of our 7-hour courses. We've been teaching these courses for over 10 years now. The Retirement Education Foundation is a nonprofit to provide financial literacy really specific to retirement planning, right? These courses are taught at all the major universities. We teach them at the University of Michigan, Eastern Michigan University, Michigan State University, Oakland University, and they're taught every 2 weeks. So we're also streaming these now because of COVID. We've been streaming for the last year. If you'd like to register, all you have to do is make a $29 donation to charity, and you can go to retirementplanningedu.org. That's retirementplanningedu.org, or call 800-240-8981.
We'll be back. There's much more with Kirk and Paul straight ahead. This is the Retirement Education Hour. Megan Mozak here with financial instructors Kirk Cassidy and Dr. Paul Mettler of the Retirement Education Foundation. Are you on Facebook? If you are, be sure to give a follow to the Retirement Education Foundation. That way you can stay up to date on everything the foundation is offering, including the courses we told you about earlier. Remember, you can get registered, and these are taught at local universities, including the University of Michigan, Eastern Michigan University, Michigan State University, Novi Campus, and Oakland University. It's $29 to attend. That's your registration fee. It does go to charity. You can choose either a 1-day course or a 2-day course. Here's how you register. Either call 800-240-8981, or you can register online. Go to retirementplanningedu.org. That's retirementplanningedu.org. We're talking about expectation versus reality here on the show. And when it comes to market returns, wow, there's a lot for us to learn when it comes to what we should expect versus what we'll probably receive. Can we go back just a half step here, Kirk and Paul, and remind our listeners what the average retail investor thinks they're going to get on a return percentage-wise?
Sure, Megan, because what's interesting is it's exploded. It literally has exploded in a 2-year period of time. If we just look back to January of 2019, retail investors' expectations were having about 11% return. It was 10.9 to be exact. Today, when surveyed, we're looking at over 17%. That's net of inflation. So closer to 20% when you factor inflation.
So 2 years later, right. 2 years later,
after a global pandemic and a 34% market crash.
Right. When you put it in context like that,
yeah.
Right? 2 years later, after, the world was ending, almost double. People right now expect almost double what they expected 2019 for the market over the next year.
Paul, you're right. It's total recency bias, right? I get that, but it's an overconfidence that people that are listening right now, and I'm not picking on anybody, but many of you who have been very financially successful, particularly the baby boomer generation, might be a little bit overconfident in their knowledge and understanding of markets. It's just, and I'm not picking on you guys, but so an expected rate of return of even 11% is crazy. I mean, first, now I know some of you will probably sitting in your cars driving and listening and saying, yeah, but the S&P 500 over the last 30 years has performed at just about 11%. That's why we expect 11%. But I'm going to ask all of you, how many of you are 100% in stocks? Right? The S&P 500 is 100% in stocks. I think one of the disconnects is everyone wants to compare their returns and their expectations to the index, the entire stock market, assuming they don't own any cash, any bonds, any annuities, whatever it is, REITs, whatever it is you're investing is. So expectations and reality is there's always a disconnect.
Right.
But really disconnected now.
Right. And if I could add, not only are the majority of our listeners not 100% in equities, but I would guarantee the majority of our listeners are in all mutual funds.
Oh, for
right?
sure.
So there's a big difference between having all your money in the S&P and having money allocated to a variety of mutual funds that are not all in equities. I mean,
Paul,
it's a huge difference.
I love that you brought that up. That is such a critical point because people look at recency bias, right? A great example is they look at the last 5 years of performance or 10 years of performance. Look, here's the fact. 40% of all mutual funds fail after 10 years. There is not a mutual fund manager who's been able to stay in the top 25% in performance over a 5-year period in history, okay? So you guys own your mutual funds and you're expecting to keep up with the S&P 500 over an extended period of time, and you're not going to.
What's the statistic? We talked about in the last 30 years, the average rate of return in the S&P is 10%. What is the average rate of return for the average mutual fund in the last 30 years?
The average mutual fund's performing at 3.98% over the last 30 years.
Okay, so you got to think.
Hold on, average retail investor, you want to know what you guys are performing at over the last 30 years? It's just a little bit over 3% now.
Right. So here's the. I mean, we sort of laugh, joke, but here it's serious for people out there who assume the market's going to average almost 20% when they have all their money in mutual funds, which has averaged maybe 3%.
No, 3.98.
They're making the problem is they're making decisions about their future retirement based on these expectations. And that's where there's really that's dangerous. And we're going to get into why it's dangerous, but that's a real problem.
Well, in segments to come, we're going to talk about really what drives performance in retirement, and it's not the rate of return. I know you guys aren't going to believe us until you hear it, and we're going to also guide you to our website so you can play with what we call sequence of return calculators to literally show you what's going to drive performance. It's not the rate of return when you're pulling money out. We'll talk about that in segments to come. But going back to expectations and reality, so before 2021's retail investor expecting close to 20% returns, and the reality is they're performing at their real returns have been around 3% over the last 30 years. People are setting themselves up for failure. And I think we've seen this so many times in history where us Americans have short memories, right? We forget the pain we go through when we have major market events. We just had one in COVID. We have people behaving irrational around elections, right? And so when you're trying to time markets and go in and out of markets, you're not going to come close to that expected return, right? Look, if you just missed 30 of the best days over the last 30 years, you have a negative rate of return right now. That's the fact.
Right.
So they can have their expectations all they want, but when their behaviors cause them to do different things, they're not going to get it. The danger is when they build plans based upon those expectations.
Yeah, I was just going to say there's a big difference between average. Regardless, average rates of return are sort of irrelevant, anyways. I mean, we're going to talk about that, right? Who cares if your average rate of return is 10%? What matters is when are you taking your money out?
That's it,
right? That's all that matters, right?
It is, and I think people are probably confused by that, but we'll cover that in the next segment. And we cover it in our classes. That's why we spend 7 hours breaking down how to construct a retirement plan. And trust me, it's not what investments you choose. It's when you're taking income from which accounts at what age, how you take your Social Security, when you take your pension versus lump sum, which we're going to cover later today. It's taxes. There's so many variables, and that's why we do these 7-hour advanced classes that we're teaching at all the major universities right now and streaming live because of COVID. If you'd like to register for one of these classes at any of the major universities, all you have to do is make a $29 donation to charity, and you can go to retirementplanningedu.org. That's retirementplanningedu.org. 800-240-8981.
And the conversation with Kirk and Paul continues straight ahead. Here with Kirk Cassidy and Dr. Paul Mettler, they're financial instructors with the Retirement Education Foundation. Don't forget to follow the foundation on Facebook. And if you're ready to get registered for the upcoming courses the foundation sponsors, be sure to go to the website. You can register there. Very easy. retirementplanningedu.org. That's retirementplanningedu.org. Or you can call to register 800-240-8981. What is a reasonable expectation of rate of return in the market? It's the question we're asking. And it's interesting, Kirk and Paul, you shared that the average retail investor thinks 17% is a legitimate expectation for their rate of return. Wow, not accurate, correct? What is more accurate?
Well, here's what institutional money managers are and the major investment banks are projecting over the next 10 years. And we're going to give you the number. I think we mentioned it in the first segment. Let's give it again. But I also think it's important we talk, what are some of the headwinds that may cause the reality versus expectations of the retail investor to be off, right? So here it is. If you look at Morgan Stanley, JP Morgan, Goldman Sachs, there's a few others, their forward projections over the next 10 years on a 60-40 allocation, right? 60 stocks, 40% bonds, they're projecting right around 3%. And remember, this show is focused on those people within 10 years of retirement throughout retirement. So most of you are going to have something similar to a 60-40 allocation. So your expected return should be somewhere between 3 and 4%, which is okay. There's a way to succeed with that kind of allocation if you know what you're doing, right? And that's why we talk about and teach in the class. But I think what's important is, why are the expectations so much lower than historical performance has been?
Right.
It's less than 50% of what historical performance on a 60-40 allocation has been.
Right.
Why, Paul? Give me some of the reasons.
So, I mean, there's several headwinds, but one of them is job growth, right? There's real concern about job growth. Why? Well, first of all, we are in the middle of a pandemic. Some people are afraid to go back to work, right? People are getting a lot of money sitting home. This is not a political statement, good or bad.
Yep.
But there are people who make more money staying home than going to work. So everybody has seen this. You go into restaurants, they can't find employees, right? It's hard to get employees because it's more attractive not to work, right? And there's some supply chain issues, which again, I don't want to get into the details.
A lot of supply
but
chain
there's a lot of
issues.
Supply chain issues. So I don't know if anyone has recently tried to update their house, right? Or build an addition. It's hard to get lumber, right?
Buy a car.
Impossible to buy a car, right? And the cost of cars is crazy right now, right? So there's a real supply chain. All of these things make job growth a concern. And at the end of the day, the feds can do a lot of things to try to keep this economy going, right? And they've done a lot of crazy things to do it.
A lot of crazy things.
But at the end of the day, if people don't work, the economy doesn't churn, right? People aren't working, the economy doesn't churn, and job growth is an issue.
So job growth is an issue. A few other headwinds. Inflation.
Yes.
Right? And some say it's short.
Right.
Term inflation.
Right.
I know the Fed uses different language. We're going to use language on our show that I hope everyone can understand. Short-term inflation is what many people are predicting. There are many that predict this is more long-term inflation that we're going to experience. Whatever it is, short or long, I can tell you there isn't a consensus, and there rarely ever is.
Right.
But that's a major headwind, because when we see inflation, we're going to see interest rates rise. And when interest rates rise, your bonds are, particularly most of our listeners' bonds because they're stuck. They're in their 401ks. They're in mutual funds that are buying longer term bonds. And when interest rates rise, your bonds are they're going to get crushed. I'm using English, right? So we promised English. They're going to get crushed. You're going to lose money in your bond funds as interest rates rise. That's how they work. Is interest rates go up, the value of your bonds are going to go down.
Right.
And here's the general rule of thumb for a long-term bond. For every 1% interest rates rise, your bonds will go down 10%. So when you look at a 60% equity portfolio, 40% bond portfolio, these are some of the contributing factors for why most investment banks and experts' forward projections are about 3%.
Right. Can I add one thing to that?
Please.
So the connection between interest rates here is obviously the Fed, we like a little inflation, right?
We do.
But if
the war on seniors and savers has been going on long enough.
Right. We need to make money in our savings account.
Yes.
However, too much inflation scares the Feds. And if it goes too high and the economy starts heating up too much, what are they going to do?
Yeah.
They have to raise interest rates to try to slow the economy down. And when they do that, that's a headwind in the market.
Well, it is. And here's another one that, again, we don't want to get too wonky and too much in the weeds, but the valuations of the companies we are buying today, when we're investing in a company, the price you pay for that company matters. I mean, look, I would encourage all of you go back and look at Microsoft, Verizon. What was the third one? Microsoft, Verizon. What's the other one that we were going to talk about?
Apple.
Oh, Disney.
Disney.
Yeah, Microsoft, Verizon, and Disney. I want you to look at the price of Microsoft, Verizon, and Disney in 2000. I want you to look at the stock price of those companies in 2000. If you own those from 2000 to 2015, you didn't make money. In fact, you might have lost some money. Doesn't mean the companies weren't great. They were great. Their earnings, some of them doubled, tripled during that period of time. But we saw the stock prices stay flat or even go down. And the reason why is because in 2000, the multiples, what you paid for that stock was very high. I don't want to get too much in the weeds, but Paul, many people are arguing and suggesting the multiples are high again. Now, one more thing, really quick, and we're running out of time. A lot of these high-flying growth companies, Paul, right, are based on projected future earnings. Some of those companies aren't even making any money yet. When we see inflation, if we see inflation, that means the value of a dollar is worth less, right? The value of those future growth projections are worth less if we see inflation. So these are some of the headwinds that people are concerned with. And it's why conventional wisdom is not going to get you through your retirement given all the different market challenges we face today. It's different this time. I know everyone says that all the time. It's truly different. Income planning is going to drive your success in retirement, and it's why you need to invest 7 hours of your time to attend one of our courses that we're teaching at all the major universities. We're at every university. All you have to do is make a $29 donation, and you can register at retirementplanningedu.org. That's retirementplanningedu.org, or call 800-240-8981.
And we'll be back in just a moment. Happy to be alongside Kirk Cassidy and Dr. Paul Mettler of the Retirement Education Foundation. Kirk and Paul are financial instructors, and they help the foundation with courses that are taught throughout the year at local universities. And these are courses that are truly a deep dive into everything you need to understand about retirement planning so you can have your dream retirement. We agree. We believe that you deserve a great retirement, but it starts with good planning. And you can find out what that entails by attending these courses. There's 2 easy ways to get registered. You can do it by phone. Just call 800-240-8981. Or you're welcome to register online at your convenience. Go to retirementplanningedu.org. Expectation versus reality. What should you expect to receive in terms of rate of return in the market? Kirk and Paul are opening our eyes on this one. We were talking about headwinds, and I wanted you to recap one of those in particular. That's valuation. Talk to me about that, Kirk and Paul.
So Paul wanted me to bring this back up, and since he's my older brother, we are truly brothers, I have to listen and respect my older brother.
Wait, this is being
recorded?
So everyone hears
on
that.
Radio.
Everyone knows that. I like that. Okay, thank you.
Paul is my older brother.
Yeah, okay. I don't need that.
So you get a little, I take a little, right?
Yeah, fair enough.
So he felt like we rushed through valuations and why that's such a headwind. And it is because currently I don't want to get wonky, Paul, because I feel like we lose some people when we do that. But the cost to buy a stock today is relatively high compared to historical.
Very high.
It is.
Very high,
I'm being
actually.
fair. People are on both sides of this, so I want to be careful. But it's high, right? And so what you pay for your stock matters. It does. And I know that people want to argue it doesn't, but it does, particularly as we get older, because your time frame of when you need to take money out of those investments are sooner. It's not forever, right? Relatively soon, if you're within 5 to 10 years of retirement or in retirement, you're going to have to take money out of these. So great example we brought up in the last segment was Disney, Verizon, and what was the last one? Microsoft. 3 companies that have just boomed, right? All 3 are doing really well over the last 5-7 years, right? But that wasn't the case from 2000 to 2015. I wish I had the charts pulled up because from 2000 to 2015, you didn't make money if you owned Microsoft, Verizon, and Disney. You didn't make money, right? Now, Microsoft, Verizon, and Disney did make money. They did really well. Their earnings, some cases, tripled with those companies, but the stock price stayed flat or even lost a little bit of money. So it's because if you bought it in 2000, the multiple you were paying to buy those companies was really high.
Right. Can I put a number to this?
Yeah, please.
So there's something called a PE ratio, right? The price of the stock versus the earnings per share. And right now, I think what's the average PE ratio is about 21. Okay. And based on that, if we just look at a chart, based on that, the future expectation when you have a price per a PE ratio is anywhere between 0 and 3% growth. That's what you should expect. And the best way to think about this is, imagine if you bought a house. If you pay a lot of money for a house and one day you want to sell that house, obviously your future profit is going to be a lot less than if you buy a house low. People saw this in 2008, right? The housing bust, right? People were paying obscene amount of money to buy homes, and when the housing market died, people lost a lot of money. So anytime you pay a premium for an asset, and then in the future you want to sell it, right, you take a huge risk.
That's the piece, Paul. In the future, you want to sell it.
That's right.
When we're young, we've got
not
time.
selling. That's right.
Now, there's very few of you, let's be honest, bought Microsoft, Verizon, and Disney in 2000 are still holding it. Let's all be honest. Because Kramers, all the market timers, stock pickers, there isn't many people. We know that factually. There's data. Very few people still own that, right? So, and held it through the whole time. But if you did, and you were a buy and hold person, well, you're winning. The problem is once you retire, you're going to have to take income from investments. That's why what drives performance, Paul, and we're going to talk about this for an entire segment, what drives performance is when you take income from which investments. And that's why building a retirement plan, including when you take income, what you invest in and which accounts you plan to take the money from, is really the key to success. That's going to drive, not average rates of returns. It's not. Because if we pull money from your investments and they're flat or down, it will, especially in the first 5 years of retirement, the chances of you outliving your money increase by 75%. Income planning, sequence of returns is what drives performance, Paul.
Wait, what was that statistic? One more time.
If you have a market event in the first 5 years of retirement, your chances of outliving your money increase by 75%.
Right.
And that's because none of you have mapped out strategically which accounts to take money from at what time. So those accounts you're going to take money from early need to be managed very differently than those accounts you're going to take money from in 5 years, than those accounts you're going to take money from in 10 years, and those accounts you're going to need money in 20 years from.
This is the reason why the whole subject of rates of return is useless. I mean, we have the whole show talking about rates of return when, in the end of the day, if you're 5 to 10 years from retirement, you shouldn't even think about rates of return, because that is not what's going to drive how successful you are and whether you outlive your money.
You
It
do
will not.
understand this is taboo, what we're talking about. Our industry, I mean, it's against everything our industry wants us to talk about.
Talk to somebody who retired in the middle of a correction, and they will tell you, I don't really care what the average rate of return is. When I was selling, when the market was down, it
destroyed you. Right? You're down 34%. That means market and taking income, it takes over 50% to break even. It's just the way, it's sequence of, I encourage everyone to go to the website, retirementplanningedu.org, and play with the sequence of return calculators, and you'll learn. It'll show you how you can have an average 6% rate of return and run out of money in 17 years if you're only taking out 5% a year. It's what happened early in retirement. You can play around with the calculator, and you'll see this is the most critical piece.
And we talk a lot about this in the class, do we not?
This is the class,
it's a
right?
huge
Building
piece.
the plan
That's
for
right.
30 years and what you should invest in what segment of your retirement.
I mean, we give examples of sequence of return that are powerful in the class.
Oh, yeah. We show a 10% average rate of return over 20 years. Someone taking out 5% a year to live on, and they run out of money in 17 years.
Right.
Just tell me what happens early, and you'll decide. So I'm hoping you guys are catching on. I feel like we beg people to attend this 7-hour course. This is an advanced course. This isn't basic financial literacy. This is an advanced course on how to construct a retirement plan. Taught at all the major universities. It's not an accident we're at all the major universities, right? All you have to do is make a $29 donation to charity, and you can register at retirementplanningedu.org. That's retirementplanningedu.org, or call 800-240-8981.
And we'll be back right after this. Happy to be here with Kirk Cassidy and Dr. Paul Mettler with the Retirement Education Foundation. Kirk and Paul are financial instructors. They teach courses at local universities. These are really intensive courses on retirement planning, what it takes to have a solid, successful retirement in the 21st century. So this is a deep dive. We want to prepare you to come for either a 2-day course or a 1-day course. And again, they're taught at local universities, including the University of Michigan, Eastern Michigan University, Michigan State University Novi Campus, and Oakland University. Here's how you register. Go to the website, retirementplanningedu.org. That's retirementplanningedu.org. If you'd like to call, you can register that way as well. 800-240-8981. Kirk and Paul, part of retirement planning and a key component is getting your income plan right, having that comprehensive income strategy. And for many people in our community, that means factoring in a pension. And boy, do you want to get your pension decision correct. There's a lot at stake, isn't there?
So there is, and there's a lot going on right now. So we've committed every radio show that we're doing for the next month or two, that at least one segment, we're going to talk about this variable around lump sum versus a pension income stream, because there is a lot of confusion, and how many of you are making this decision is wrong. I'm sorry, I'm just being candid. And how most financial advisors in our industry are helping you make this decision is wrong as well. This is a much more complicated question than comparing the amount of guaranteed income you can create from a pension versus how much income you can create from the lump sum. It's more complicated, and it's not a simple calculation. It has to be looked at holistically, including what kind of assets. Do I have a lot of 401k? Do I have Roth? Do I have non-retirement assets? What does my Social Security look like? Do I have a spouse? What is the health of both of my spouses? What about my children? These are all variables, and we'll give some examples, Paul, and I hope I don't dominate this whole segment. I'm sorry, but there's so much to cover here, and we only have one segment. Many of you are going to be confronted with the decision. I know some of the major automotive companies are making some offers to have you retire early, and candidly, for a lot of you, if you're within 3 years of retirement, you need to come to a class and decide. Many of you are going to work for 2 or 3 more years, and it's going to cost you money to work. I know that doesn't make sense. Many of you already have enough to give you what you want in retirement, but your fear is holding you back from pulling the trigger to take that lump sum pension or even retire. So you need to understand your pension lump sums are going to be impacted by interest rates, more specifically the 10-year corporate rates. And as those interest rates rise, the value of your lump sums are going to go down, not by a little. If you all look at your lump sums, just take a look and you'll see over the last 2 years, they're up over 20%. It's because interest rates were falling. When interest rates fall, lump sums go up. When interest rates go up, like they're projected to go up, your lump sums are going to come down. And here's the deal. For every 1% the interest rates go up, your lump sums will approximately decrease by 10%. So if you have $1 million lump sum, that's $100,000 a year that you could be losing by continuing to work if interest rates go up. Now, the lump sum decision has so many variables, and a lot of it's around taxes. A lot of it's around long-term care, which is a major variable. We should do a whole show on this. Maybe the next show is a whole show just talking about lump sum versus pension and how to make this decision. Because candidly, you could replace, right now, take your lump sum and replace insured guaranteed income the same or greater than the pension income they're giving you. Then the question is, do you really need that much guaranteed taxable income if you have other assets that might be more tax favorable? Am I confusing people, Paul?
No, you're not. You're not. There's one variable I think you're about to say. I don't want to make sure it gets said, which is the biggest difference, though, is when you take that lump sum, right, it's your money, right? So what happens is if you pass – well, it's not if. We all pass away. When you pass away, if there's money left in that lump sum, then it passes on to the next generation. Versus if you take the annuity from the company, when you die, it's gone.
So that's one variable.
Right.
And so I know some of you say, but the guaranteed, I need the guaranteed. You can create the guaranteed. And the last thing I would encourage anyone to do, the last thing you should do is take that lump sum and go stick it in the stock market with a 17% expected rate of return.
People are going to do that.
I know. And that would be the biggest mistake that you could make in your lifetime financially. I'm not exaggerating. You must reinsure whatever the amount of guaranteed income your plan will need. It might not be the entire pension amount. So you might take a portion of that lump sum and create your own pension, which you can insured, but also have some protections for long-term care. There are products out there that can give you guaranteed income and long-term care benefits that your pension will not give you. And then there's the tax.
And that's
variable.
not long-term care insurance.
No, it's not long-term care insurance. It's just increased long-term care income benefits if you have an event. Like I said, it is really complicated. In one segment, we're not covering it all. But trust me, please come to a class so you understand the tax variables around pension versus lump sum. It is huge. It impacts the taxable portion of Social Security, impacts the taxable portion of your required minimum distributions. So if you take a pension, will impact how much you pay for Medicare. There are so many variables that people have to educate themselves, and our industry doesn't do this. They just don't. They don't do forward income tax planning.
Right.
So they're giving advice without all the information.
In fact, often don't even give advice. They make assumptions. They just assume you're going to do it because they don't want to spend the time thinking through really what's the best strategy for you.
Well, I can tell you in our private practices, when we build a retirement plan, it's a 40-hour process. 40 hours. I want everyone to think about that's a full week that we're spending on a plan, the whole week, mapping out when, how, and why. Because taxes are complex. Market events, we're going to have 3 to 7 market events in anyone's retirement, major market events. And making sure you have the ability to pivot to the right accounts during those market events are critical. There's so much to learn and so much ignored by our industry because they want simplicity. Come to our 7-hour courses. Look, it's not an accident we're teaching at all the major universities, right? It's 7 hours. It's an advanced download on how to build a retirement plan. If you'd like to register for one of our classes, all you have to do is make a $29 donation to charity, and you can go to retirementplanningedu.org. That's retirementplanningedu.org, or call 800-240-8981.
Our show continues straight ahead with Kirk and Paul. You're listening to the Retirement Education Hour. Happy to be alongside Kirk Cassidy and Dr. Paul Mettler with the Retirement Education Foundation. They're both financial instructors. And if you're interested in sitting down with them at the courses that they teach here at local universities, well, I have some good news for you. You can register to reserve your spot today. And you can do that by going to the website. It's retirementplanningedu.org. Go there to register, or feel free to use the phone number 800-240-8981. These are intensive courses designed to give you more confidence around your retirement future. And they're taught at local universities here, including the University of Michigan, Eastern Michigan University, Michigan State University Novi campus, or Oakland University. There's also an online option. So again, go to the website for much more information. It's retirementplanningedu.org. It's been a fantastic show today. I've learned a lot about our expectations as it relates to market returns. And I want to ask you this, Kirk and Paul, when we're thinking about how to be invested in the market, what should we be looking for personally? What types of needs should we be examining before we make an investment strategy?
So I love this question, and it is a different answer depending on where you're at in your life. So given the audience that we have that listens to our show is focused on those people within 10 years of retirement through retirement. Your objective on how and what to invest in needs to be driven by what your needs will be in retirement. This is very different what the book says, or conventional wisdom, or my favorite segment in our little TV show we do every 2 weeks, They Say segment, right? It is not your age or how close you are to retirement. It is how close you are to get what you want throughout retirement. Because here's the deal. Paul brings this up a lot, right? His background is in psychology, and he talks about the emotions and relationship with money, and greed is a major variable, particularly right now when we've had such a long expansion in the market, bull run in the market, right? Greed shouldn't drive our decisions. What I need to give me what I want in retirement needs to drive this. And I'll quote Warren Buffett. Ready, Paul? I quote it every show. You have to be insane to risk what you have for something you don't need. I'm going to say it one more time. You have to be insane to risk what you have for something you don't need. So your risk should be driven based upon your needs. The only way you know, here's the problem with that, Paul, by the way. It sounds simple, but the only way you're going to know if you have what you need, or to figure out what you need in retirement, is to understand how to build a 30-year retirement plan. It's not a spreadsheet. There are too many variables, folks. There's 3 to 7. We'll call it 3 to 7 major market events that are going to go on during your retirement that you may need to be able to pivot and understand how to minimize that pain to your retirement, right? It's how and when to take income from which accounts at what age to minimize taxes, to take Social Security, pension or lump sum, surviving spouse, taxes for surviving spouse, long-term care and health events. I know that people talk about this, but very few people really plan for it. And to build your risk tolerance and to build a portfolio, though, Paul, without really understanding what you need to give you what you want in retirement, you're guessing.
Yeah.
And that's why there's these general rules and people go based upon your age.
Right.
The rule of 100, all this garbage that people use.
I want to go back to greed, because you said that really quickly, but I think no one who's listening thinks they're greedy, right? No one ever wants to admit, right, I'm not greedy. I met someone recently who every year they're getting older, their net worth is only increasing. They will never spend all their money. We were able to show them after building their plan, and they still have this perception that they want to take crazy risk. And when I'm greed. I'm sorry. And at the end of the day, when I pointed that out, I'm not greedy. Of course you're being greedy. And once I pointed out, it was like, you're right. I don't need to do this.
Well, so Paul, it could not. There's a secondary ego, particularly for men.
It's a great point, because actually for this particular person, it was a combination of ego and greed. Great point.
I guarantee it, right? My friend they're talking about this.
Right.
I should get, why aren't I not getting this? Because you don't need that.
That's right.
When you go to try to drive big returns, which is fine if that's what you need or you have plenty of extra, that's fine if you do that. But when you go to drive large returns, you are assuming larger risk, right? And Warren Buffett says it. You've got to be insane to risk what you have for something you don't need. This is why your relationship with money has to change as you're approaching retirement and in retirement.
And this is why, going back to the whole show, people's expectations of the market are causing problems. Because people are walking around thinking, I can get 17%, why not do it? Without realizing it doesn't, I mean, at the end of the day, not only does it not matter if you don't need it, but the risks you're willing to take to get it, at the end of the day, are going to really hurt you significantly.
Most people won't need it. They don't even get that they don't need anywhere close to that. And I'll prove your point, Paul. People are getting so over their skis, as I like to say, taking on so much risk because of this expectation that's created in their peers and their friends and what they read, and they get caught up in it. Just remind everyone, 35% of people over the age of 65, 35% panicked in March during COVID and missed the entire boom. They missed it because they panicked. Now, I know you guys are going to say, yeah, but that's on me. I'm not the 35%. Look, I'm going to promise you something. I mean, we've taught thousands of people. We've constructed thousands of plans. I'm going to promise you, as you get older and someone else isn't paying you a paycheck and you have to pay yourself a paycheck, anxiety and fear is the variable. Old people aren't cheap. I say it all the time. They're not cheap. They're scared.
Yeah, your relationship with money will change, no doubt, when you retire.
So don't set yourself up for failure. Set yourself up for success by understanding how to construct a retirement plan and what a retirement plan actually looks like, because you haven't seen one. That's why we teach these 7-hour courses, and that's why they let us teach at all these major universities 7-hour courses. During COVID, we're also streaming it. So if you're uncomfortable coming to the class, you can stream it. All you have to do is make a $29 donation to charity. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org, or you can call 800-240-8981.
Investment advisory services are offered by Strategic Investment Advisors, Inc., an SEC-registered investment advisory firm. Investing involves risk, including the potential loss of principal. Any insurance discussed in this show is backed by the financial strength and claims-paying abilities of the issuing carrier. This show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Retirement Education Foundation is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Retirement Education Foundation. This radio show is a paid placement.